Historically, the US stock market has provided an average return of around 8% to 9% per year. But in recent decades, that average 8 to 9% yearly return has ticked up, and now the market has seen roughly 10% average returns per year. However, according to many of the largest financial institutions, they now expect stock market returns to slow down significantly in the next 10 years. Goldman Sachs recently gave an update on their market forecast, which is a lot more negative than what it previously was. In their global strategy paper, Goldman says that they estimate the S&P 500 will deliver an annualized nominal total return of just 3% in the next 10 years, 7th percentile since 1930, and roughly 1% on a real basis. Our forecast suggests equities will face stiff competition from other assets during the next decade. Our 3% annualized equity return forecast, combined with a current 10-year U.S. Treasury yield of 4% and 10-year break-even inflation of 2.2%, suggests the S&P 500 has roughly a 72% possibility of trailing bonds, and a 33% likelihood of lagging inflation throughout 2034. Another large firm that came out with their own forecast was Vanguard. On July 23rd, they published their own updated forecast on their website, which says the following. Our expected returns of most U.S. sub-asset classes has fallen as of June 30th, 2025. Corporate fundamentals remain resilient in the face of tariff uncertainty, supported by the recent equity rally. Hopes for a Federal Reserve rate cut raises bond prices. The ongoing strength in equities reinforces Vanguard's case that bonds are attractive relative to U.S. stocks, which we anticipate will offer returns below their long-term historical averages over the next decade. The following are highlights of the changes in our 10-year annualized return forecasts relative to our previous set of forecasts. We now expect U.S. equities to return 3.3% to 5.3%, which is down 0.5 percentage points from their previous forecast. They also anticipate U.S. growth stocks returning 1.9% to 3.9%, down 0.6 percentage points from their previous estimate, and they also expect U.S. aggregate bonds to return 4% to 5%, down 0.2 percentage points. The U.S. equity market continues to trade well above the top end of its fair value range. Our estimate reflects our proprietary fair value measure, which considers current prices in relation to average inflation-adjusted corporate earnings over the past 10 years, as well as prevailing interest rates and inflation levels. Many other large companies have their own forecasts, and they're all much more negative when compared to typical stock market returns. Fidelity released a 20-year forecast in which they anticipate nominal returns being just 5.7% per year. Those are some pretty mediocre returns over the next 2 decades. Schwab anticipates returns being 6% per year in U.S. equities, which they lowered from their previous forecast. BlackRock appears to be the most optimistic when it comes to stock market projections, but they're still expecting much lower returns than what we typically see. They're claiming the average yearly return over the next decade is going to be 6.2%. So what are the main drivers behind all of these negative predictions? It looks like the 2 most common reasons appear to be tariffs and stock overvaluations. With President Trump imposing tariffs and making changes on a pretty frequent basis, it's resulted in all of these firms becoming much more pessimistic about the long-term future of stock market returns. The second major reason is because the stock market is very overvalued. According to every common metric that's used, the US stock market is considerably overvalued right now. That would include the Shiller PE ratio, the Warren Buffett indicator, the Q ratio, and other measures. Now, ultimately, all of these predictions are just predictions. There's no guarantee that they'll be accurate, and obviously some are going to be more off than others. But the main point that should be noted is that everyone is expecting stock market share price returns to slow significantly over the next decade, according to all of these forecasts. If all of these major institutions are correct and we either see flatlining share prices or very small 2 or 3 or 4% yearly returns, then that means one thing. That'll mean the higher yielding investments have a really good chance of outperforming the market for many years in the future. For decades, the market has been obsessed with tech companies. These stocks have been the shining stars of Wall Street, and a lot of their valuations have exploded beyond the point of what's considered reasonable. And as a result of this, many of the heavy dividend-paying sectors have been overlooked for a while. Many of these sectors are still providing very solid returns, including utilities and consumer staples, to name a few. Now, it's entirely possible that tech companies could still continue to explode for a while. It's just right now, we're going to be facing a much more challenging environment for these aggressive growth companies. The investments that pay dividends will likely see much more interest in the years ahead. A lot of these higher yielding asset classes are known for offering high distributions and not a lot of share price growth. If equities are going to see very small gains in share price over the next decade, then these flat share price investments that yield 8% or 12% stand to outperform the S&P 500. Let's go back to a couple of the points that were made in these articles. Goldman Sachs is predicting that bonds have a 72% chance of outperforming the S&P 500 over the next decade. A lot of closed-end funds hold bonds and other fixed income assets and offer yields of well over 10%. Although most CEFs don't see a lot of share price action, they're known for their distribution stability. It wasn't just Goldman that said bonds were likely to outperform. The exact same point was made by Vanguard, who claimed that bonds will likely outperform the market by a good amount over the next 10 years. So with all this in mind, basically anything that pays a worthwhile dividend is going to look more attractive over the next decade. Even real estate investment trusts, while they do offer lower yields than the higher yielding asset classes, they will become more attractive as we see interest rate cuts. And it's not hard to figure out. Ultimately, if investment A provides 10% yearly gains in share price and no dividends, you get a 10% return. If investment B offers a 10% dividend yield and no share price growth, you're still getting a 10% return. But if all these forecasts are correct, then investment B is always going to look more appealing. There's a lot of other higher yielding investments that exist that'll outperform the market if just a couple of these forecasts are correct. Business development companies are another higher yielding investment that are known for prioritizing dividends over share price growth. These stocks often come with yields of between 8% and 12%. So if we're talking about share price gains over the next decade, then BDCs are going to be another type of investment that'll do much better than the market average. But there's one high-yielding investment type that's really going to shine if we do enter a flat market, or experience very limited share price increases, which are covered call ETFs. When the market's flat, these funds can still generate 8 to 14% returns through their distributions using option strategies. They do well in other conditions, including when the market is rising, but in the event of a slow rising market or if things are flat, then covered call funds are another option that can outperform the S&P. So that covers all the major forecasts on how these institutions think the market's going to do over the next 10 years. No matter how things go, if share prices move up, down, or sideways, dividend investors like us will always get our income. We don't need to focus on selling shares to fund our lifestyles. It's all about the income they pay us. Feel free to let me know your thoughts. Do you think the market is really going to see these really small returns they suggested over the next decade? Or do you think share prices are going to continue to rip up as they have for a while? Let me know your thoughts, but with that being said, that's going to wrap up today's video. If you'd like to connect with me and see what's inside of my own high-yielding dividend portfolio, then feel free to check me out over on Patreon. You'll be notified when I make trades, and you'll get access to our Discord with other high-yielding investors. Thanks again for watching. Please be sure to like this video and subscribe if you want more high-yielding investment content. Thanks again for watching, and I hope you all have a great day.